Earnings are back, baby. We're doing our immediate reaction literally a minute ago. Netflix reported earnings, memberships, and we are already recording a video. It is 4:07 p.m. Eastern time. This will be posted by 5 p.m. Eastern time. Is that a reasonable estimation, Tim? 5 p.m. it'll be posted? Before 5 p.m. So this is why you subscribe to the channel. Make sure you subscribe. Make sure you share this video with friends who might be talking about Netflix. Guys, we're here to look at Netflix, the 8 pillars. First off, they were expected to make 42 cents per share. They made 12 cents per share. Poop. They were expected to do $7.85 billion in revenue. They did $7.85 billion in revenue. They were expected to get 4.1 million subscribers. They got 7.66 million subscribers. And I'm guaranteeing you that is entirely why the stock is up a ton after hours. According to our software, it's up $20 right now, 6.5%. This stock has been on a roller coaster for the last year, and paying subs are now a total of 227.4 million subscribers. So guys, look at this 5-year chart on Netflix. So back in 2021, it hit a high of November 17th at $700 a share. It hit a low recently of $162 a share. Somewhere around there.
162.71.
That's a fall of 87, 86%. What is that? Something like that?
It's a lot.
I'm wrong.
It's a lot.
No, 77%. Yes, 77%.
It's a lot.
Guys, this is what happens. Voting machine. But in the long run, it'll be a weighing machine. So if you're new to the channel, we use our 8 pillars to look at companies. You have to remember, when you buy a stock, Mo, what are you buying when you buy a stock?
Piece of a company.
You're buying a piece of a company. You're buying a piece of a business. You're buying a stream of cash flow. The cash flow is unknown in the future. We have to use estimations today, and we will show you how to do that using our stock analyzer tool shortly to determine the price to pay for Netflix. But let's look at some higher metric stuff. First off, I'm going to make this a little bit bigger for our lovely viewers out there. Market cap for Netflix, $145.6 billion. This is before
How the mighty have fallen.
the enterprise value was $166 billion. This difference is the difference between debt and net cash and debt and all that stuff. So not a ton. Gross margin, 40%. Profit margin, 16%, but 5-year profit margin of 13.2. So this isn't bad. Okay? A little bit better next year. Now here's the thing that confuses me. 5-year average free cash flow. So they have a negative 5-year free cash flow, but they have a positive 5-year profit margin. So that's my concern with Netflix. It's immediately my concern. Mo, does that concern you?
Yeah, I was before you did this, I was pulling up their cash flow statement and I was looking back in the years, and they've not typically had positive free cash flow until recently, last 3 years. But even then, it's all over the place.
And look at what's the average 5-year free cash flow? Negative 675, right?
Yep.
Look at their net income. What's the average 5-year net income?
3.12 billion.
Yeah, so there's a big disconnect. There's a $3.8 billion difference between net income and free cash flow. That, to me, is the most important question for Netflix. How is there such a big difference?
What do you think the reason is?
I'm wondering if they're trying to capitalize a lot of their growth costs. And I don't know if that's accurate or not. Another thing that just happened, Reed Hastings, who I think is a complete and utter douchebag, is stepping down from his role at Netflix. Reed Hastings loves to hear himself talk about what a wonderful culture he's made at Netflix. That's all I'm going to say about Reed Hastings. I think it's a positive for the stock. I have no idea if he's a good CEO or not, frankly. It doesn't matter to me. But I look at this and I hate that difference between cash flow and net income. It is such a big difference. Guys, if you're new, cash flow is the lifeblood of a business. This is where you get money back. This is where you pay down debt, you pay dividends, you buy back shares, use free cash flow. Net income is after using all your accounting rules, your SEC rules, how you report the profit in your business. Over long periods of time, net income and free cash flow should be pretty similar to each other.
They've been around for a while.
Yeah, and I know they're in growth mode, and people are going to go out there and say things, and I know you're going to make comments, and most of those comments are going to be very useful. But somebody's going to say, well, Paul, they're growing. I get that, but the part that I don't understand is their capital expenditures have not been big money.
No,
not been big. I would have thought it'd be the other way around, where net income would show a much lower price than free cash flow if they were trying to expense a lot of their I don't get this. I really honestly don't get this. And this is this to me makes it too hard pile immediately.
This has always been the thing about Netflix for us. So
we have to understand how they report their net income. So let's go to the 8 pillars here. Mo, what data are you finding on their report? By the way, it's down less than 4%. It's up less than 4%.
I know, and to start, it was up 8.5%. Right?
Oh, was it really?
When they reported, it was up 8.5%. They have out here. I mean, they've had a lot of really hit series. This Harry and Meghan was the second most popular series ever.
Did you watch it?
Yes,
I did too. It
was pretty good. I mean, for what it was, I mean, you're not going to get excited about the royal family if you're normal.
Lisa asked me at the very end. Remember, they're like, "What was your one word to describe 20?" I was like, "Oh, barf."
What?
You remember at the very end of the series, Harry and Meghan went to some friend's party, and the friend was like, "One word to describe our year, our 2021 was blah, blah," or whatever it was. And I was just like, "Here we go."
Yeah, I don't remember that. So I watched it very intently, as you can see.
Yeah, it was like the very last thing in the whole series.
There's nothing really. The biggest thing that stood out for me was the number of users. I said that before we even got the report. I said, I can't wait to see what their users are. Because remember how much they fell?
That's a big jump, 7.66 million.
It's a huge jump. So maybe, I don't know. The cash flow thing has always concerned me. We have a member in our community, Gianni. I heard he talked to on a Zoom call about it recently to the community. And he was messaging me about it on Sunday, and we were discussing it, and I was like, I understand the points you're making, but the free cash flow thing is very worrisome. Yeah. At what point does this change? At what point does it change?
Yeah,
this has been going for 20 plus years this way.
So I'm not saying Netflix is a fraud. However, one of the red flags I see when it comes to companies is when the cash flow is significantly lower than the reported net income. There could be a very logical, and there probably is, and 95 out of 100 times, there's probably a very, very logical explanation for it all. I just don't know what it is here. And you might sit there and say, well, go find out. So this is what I'm going to show you next. First off, this is our 8 pillars before I go to the next thing. X, there's not enough cash flow to even cover debt. Cash flow, I mean, it's just all around. The shares outstanding isn't bad. Only increased by 2% in the last 5 years. Big deal. 2%. Yeah, I've increased my shares outstanding by more than 2%. Mm-hmm. Look at their 5-year return on invested capital. Since we changed it away from free cash flow, 5-year return on invested capital, 11.2%. Okay, not bad. Not bad at all. We went over 9%. So there's some good stuff happening here. Let's see what the analyst estimates are. Oh my God, it's only up 2.8% now, Mo.
Yeah, that was and for those of you that like trading and watch it, this is exactly why I don't trade on earnings. It's just ridiculous. You've basically swung the value of the company from 8.5% to 2.5% in a matter of 15 minutes.
If it was a $100 share, it went from 100 to 108 to 103 now.
Within a matter of 15 minutes and 28 seconds.
Yeah. By the way, Mo and I, for our long-term value investing, we don't look at quarter-to-quarter earnings as anything important. We look at what's said during those earning calls. Like, do they warn for anything that's going to be permanent change in the company? For example, hypothetical, I'll go to an extreme. All of a sudden, the U.S. government says no streaming services allowed. That would be a material change to the business. That's not happening. I'm just saying, I want to come up with some ridiculous analogy, right?
Yeah.
But you should use it as an opportunity when stocks fall hard because of recent news, as an opportunity that if it's selling below your strike price, to take advantage of that to buy it. So the question is, what is your price to buy Netflix? Remember, every investment is the present value of all future cash flow. We look at analysts right here. This year, they're expected to make $11 a share, $17 in the next 3 years. That's a pretty big jump. So today, the stock's at 340 or so. It's selling for a 20 PE for 3 years from now. Is that reasonable? I don't know. Seems high. 3 years from now, 20 PE. Okay, what about revenue growth? It's not bad. It's growing, but not huge. $35 to $40 billion. So that's what? 14.5% over the next 3 years. So it's like what, 4.5% a year compounded. All right, not great.
One of their goals for 2023 is to deliver growing positive free cash flow.
Okay, is there anything in there about, Mo, while I do the stock analyzer tool, can you look in somewhere, is it the 10K?
No, this is the press release.
Okay, can you look somewhere in the 10K about where they talk about the discrepancy, or Google it? What's the discrepancy between earnings and free cash flow at Netflix? Because this is, to me, this is the crux of the problem. And for you out there, you might be like, well, go figure it out. But to me, there are so many companies out there. I already saw this red flag, and it doesn't seem like the company is selling for a cheap price. Look at this right now. If you believe the entire company's numbers, it's still selling for a current P of 29, a 5-year P of 47. So it's not like this is 7 and this is 10 or something. It's still a really high number at 29. So you got to remember that. Now, let's go to our stock analyzer tool. Now, Netflix, more like, if anybody can guess what I was going to say next, besides anybody who knows what I'm going to say. Netflix is a company that I think is the leader in streaming. But as we said in previous Netflix videos in the past, if you go look at our almost 2,000, we haven't hit 2,000 videos yet, Tim? We'll find out. But I said that streaming is becoming a very crowded market. A lot of people are doing streaming services. By the way, it doesn't bother me at all. I belong to like all of them because it's cheaper than having cable. I look at it going, wait, I can subscribe to like 10 streaming platforms for $100 a month, or I can have cable. 2003 upload videos on, if you look at Social Blade. So we're over the 2,000 mark. Congratulations, fellas.
Thank you.
We have Netflix in there, and I kept talking about the concerns I had about Netflix when everyone was probably criticizing us when it was $700 a share. So
I wonder what Bill Ackman's thinking right now. I can't wait to remember he bought it and then he just sold it all on that fire sale when they dropped like 30 or 40%. Do you remember that?
Well,
and he
I do remember that, but that was way below this current price, I think.
Yes, it was. And that's why I'm wondering what's his thought process now.
All right. So this is our stock analyzer tool. We use this to determine the future value of a company. We make assumptions. This doesn't include the balance sheet. We make assumptions on revenue growth, profit margin, free cash flow margin. Now, this is what I was talking about. Look at the difference between profit margin and free cash flow margin. This is 1, 5, and 10-year numbers. These are big differences, and it's pretty consistently across the board, big differences. That's a problem. Then you have to assume your ending PE and price of free cash flow. And finally, and most important, your desired annual return. 10% is the market. I always put 10% in as what is this company worth? Because you can buy an ETF and make 9 or 10%. So that should be my bare minimum. The higher my desired return, the more margin of safety I'm giving myself, right? And as I make higher and higher assumptions, they're less likely to happen. So I need a larger margin of safety. So let me look at a 10-year number here. Let's go with revenue growth of 3, 5, and 7%. Profit margin. Let's go with 10, 14, and 18%. Free cash flow margin. This is the hard part, guys. Let's go with 3, 6, and 9%. PE. Now, guys, the average PE is 15. This company has a little bit better return on invested capital. Has a pretty good stake as like, I don't think it's a moat, but it's got a very good like, I don't go to Amazon Prime to just scroll. When I want to watch TV, I go to Netflix. I don't go to Amazon Prime and go, what's on Amazon Prime? Do you, Mo?
No.
No, I go to
Last
Netflix.
ditch effort.
I only go to Amazon Prime when I know something's on Amazon Prime that I want to watch.
I go there if I'm like out of options and I'm about to go to bed. They're like, all right, you get one more chance.
It's kind of like going to the bar. You're searching for women. All of a sudden, 2 o'clock, you're like, okay, I got to make a decision here. Let's go. Nick, you know that, right? Yeah. All right. So PE, let's go with 14, 16, and 18. 18 is a very high PE. But if this happens, it probably has a big moat to it. So I'm okay giving it 18 PE and a higher return on invested capital. Now, desired return. I think all of these are hard, but I think it's 12, 15, and 18. So I still want a little bit extra. Even though this is very low assumptions, I still want a little bit extra margin of safety versus the 10% for the market. But as I get higher and higher, I want a bigger margin of safety. The stock's currently at 330. I hit the analyze button. Mo, what have you found? Before we do this, Mo, what have you found for anything?
The only thing I see here is we compare free cash flow and net income, noting that the major recurring difference are excess content payments over amortization, non-cash-based stock-based compensation expense.
Oh.
Yeah. So
that's pretty important.
Cash flow. Yeah.
So what they're saying is content payments over amortization. So they might write a check for new content and they don't, that makes more sense. I just want to make sure it's not we're creating content and amortizing that. I don't like that because look at something like, for example, Queen's Gambit. Mm-hmm. if you're going to amortize that over 5 years, its real useful life was like a year.
Yeah, it's a very short time.
It's a very short period of time. So you got to make sure that's the case. So that's not bad. The question is, just because they're saying that, is that correct?
And how long do they do it for?
And how long do they do it for, et cetera. So these are the things you can find in the 10K. All right. I still don't know if it's accurate or not. There it is. Content amortization.
It gives us a time frame.
Are you
There's
seeing
42 matches? So
keep going.
I'll just flip through here.
Put schedule. Amortization schedule. Nothing. Amortization. Put 5. Just put number 5. Okay. Put amortization. You know what? This is going to be good. I'm going to look at this myself. Because, guys, I want you guys to see what we're doing here when we think about companies. So the great thing about our software is if I go to Netflix and I go to the, I don't know why it's, probably because the screen's too big.
I'm just going to keep plugging through these 42.
So let me just go right to the SEC website. Oh, why did I pick Tesla? Netflix, 10K. Last year's 10K. Amortization. The increase in operating margin is due primarily to content amortization growing at a slower rate as opposed to as compared to the 19% increase in revenue. Okay, that's good. Cost of revenue. Expenses directly associated, such as payroll. See, expenses directly associated with the acquisition, licensing, and production of content. Streaming delivery costs make up the rest. Okay, that's okay. We built our own. Okay, that's good.
Are you in the content section yet?
Cost of revenues. Okay, what page are you on?
27. Payment terms for certain content licenses and the production of content require more upfront cash payments relative to the amortization expense, but it's not giving any numbers.
So the question is that going to be a thing forever?
You would think that somewhere it would say we plan to end this.
Not end it, or it's going to really catch up soon.
Yeah, or phase it out or something.
Is it in the fixed assets?
We review it on a regular basis. We review factors that impact amortization of content assets on a regular basis.
All right, so my bottom line is this is something you have to figure out. So let's go back to our software, and I hit the analyze button. The stock's currently at 329.
Here it is.
Oh, he found it.
On average, 90% of a licensed or produced content asset is expected to be amortized within 4 years after its first month of availability.
Okay.
Yeah.
And that's licensed or produced content asset. So I'm assuming there what they're meaning is produced content asset is somebody else produces it, they buy it.
They bring it in, right?
4 years?
Yeah.
So to me, I understand that if it's like a show like Friends or The Office, if that were the possibility, I'd be like, oh, okay, that makes sense because that useful life's to be really long.
But I don't get it for the shows like Queen's Gambit or this Harry and Meghan thing.
But do they produce that in-house? And do they really, so that the important part is understanding how do they attribute the cost of like creating their own, like Harry and Meghan. They probably paid them a fee for it.
Yeah.
All right. Okay, guys. Now here's our problem. I have a low price of 87 on earnings, high price of 160, low price of 26, and a high price of 80 on discounted cash flow. You might be sitting there with your jaw on the floor.
The low was 160.71.
Do me a favor. If your jaw's on the floor, go look at our past videos when we told you these stocks aren't worth it and how literally every single one of them has fallen way more than the market. Follow our channel. This all makes sense to you. We want to teach a process because the more you learn, the less you fear. And that's the most important part about investing. You will do better and better as your mindset and your mindset's better and your fear is lower. Trust me on this one. Please subscribe and don't forget to share this with your friends. I appreciate it very much. Thanks, guys.